The following was recorded in front of a live studio audience at the Studio 21 Podcast Café. This is the United Podcast Network.
Welcome to the Stock Market Authority Podcast. I'm Bakes, Kevin Baker. I'm going to teach you how to make money in up and down markets. Very few podcasters or coaches cover this. I'll show you how to lock in profits and minimize losses to make you a better investor. So once a week, you're going to know what's going on in the world and the stock market. Welcome to the Stock Market Authority Podcast. Good morning. This is Bakes, Kevin Baker with the Stock Market Authority. Welcome. It's Wednesday morning, the 9th, day after the election. I told you stocks drive politics. If I had the paper, it wouldn't have mattered. And so let's just go and make money in this down market as we are. What I'm going to cover today, how you can crush the pros, the stock market pros. I'm going to go talk about Tesla, the stock going down, and how I'm making money in this down market with a little bit more detail. So I still like my guitar work. You know, how many guitar intros do you have on your other podcast, Chrissy?
I mean, not a lot.
Especially
not one that amazing.
Thank you. There, I'm fishing
Custom
right now,
made.
big time. Yeah. Anyway, please go to my website before I get into this. Before I forget, please go to my website, stockmarketauthority.com. Please sign up for my free newsletter. As a gift there, I tell you how to sell stocks. A lot of people don't cover this. Very few cover it. I'm good at it, and I want to make you good at it. So please subscribe to my YouTube channel. I really want to get to 1,000 plus subscribers. We're making great progress, but I really appreciate your help in advance. Please go and subscribe to my podcast. Spotify, Apple, wherever you choose to podcast, if you will. Follow on your favorite social media. I'm breaking in daily now with some new things. My disclaimer, this isn't financial advice. You're smart people. I obviously don't know your financial situation in and out. I just show you what literally I'm investing in, suggesting to my boys that they should join me with, and hopefully entertain, teach, have a lot of fun. So, how you can crush the pros, the stock market pros, and I started off with Apple in this example, and the reason being it's the number one stock in the S&P 500. It's widely known, everybody owns it, but the main thing is that it's such a big part of the indices. So I'll go into this. When I see this chart, my eye immediately goes to my sell discipline being implemented. So when it closes below the 200-day, I would have sold a third. I've never owned it individually, by the way. Just it doesn't interest me. 50-day coming down through 200 at 140, and if the 200-day starts going down, those are those three arrows you see there at the top. At 145. You're out at 145 on average. The stock's 138 right now. The sell discipline isn't perfect, but it is a discipline. And so I have an objective way of getting out of harm's way and avoiding large losses and locking in big gains that I want to impart to you. Dan Benton, that I talked about yesterday, the Goldman Sachs technology analyst from the 90s, has his list of ways to sell tech stocks, and one of the number one is sell when estimates are coming down. Well, Apple, the estimates are coming down. It's very difficult to see in the chart, but you see these two red arrows by the earnings numbers for 2023 and 2024. They're coming down. 2024 earnings growth is going to be 9%. I kind of yawn when I see that. I don't care that it's Apple. 9% doesn't get me too jacked up. The PE multiple is, if they hit those numbers 20 times, okay, not great. Dan Benton also talked about that most technology stocks are product cycle stories. That certainly fits Apple with the iPhone 14, which has been disappointing. What's next? I don't see anything on the horizon that gets anybody too excited. So my take is this is a great company with great products. I think it's a bad stock. Now, for perspective, I go back to the long-term chart. And here you see from it's almost tough to see, the 2000 stock market bubble. That's it. The tech bubble that peaked in 2000. Tech especially rolled over. Everything rolled over, but tech really was whacked. And you see this red arrow that I've drawn to the far left. And it took 5 years for Apple. Apple now is revered as this shining light on a hill. People worried it was going out of business. that it was being passed by. And so the stock breaks out to new highs at $1.37, split adjusted. Think about that, $1.37. The stock's at $138 right now. So I point to the contrast of a breakout, a buy opportunity where there's pessimism, there is some positive change coming that isn't widely expected, and then you go off on this big bull run. Now we get to the point where it's the number one component of the S&P 500. It's get to that chart, please. It's 6 to 7% of the S&P. Virtually every money manager with the S&P as a benchmark has to hug these top 10 stocks to stay in business. That's just the way it works. If you're wrong, you get fired. And so you own Apple, 6 to 7% in the index. If you hated Apple as a stock, you might own 4. So you can go to the committee and say, hey, please don't fire me. I owned enough Apple to stay around. If you're bullish as crazy, maybe you own 9% Apple. But zero is likely the answer. And there isn't an institution out there that can say that, but you as an individual investor, I think that's the answer. Next, I go to the analyst ratings. This is Apple, 43 analysts. There's 26 buys and 2 sells. And to the 43 analysts on the buy side, I say, buy a chart book. I can see from 3 city blocks that this is rolling over and is not going to make you much money this year and next. And so with 43 analysts poring over everything you could conceive about, no one, including you and me, is going to have a fundamental analytical edge on Apple. The groupthink comes in. You see the average price target, median price target, 176 versus 138 now. There aren't going to be any amazing surprises here. So, Apple is what it is. Next, I go to the style boxes. I think this is Morningstar. It might be another style box, but this is the way the industry works. And if you know all this, then tell me to shut up. But if you don't, this is the way the stock market pros manage money. There's market cap, small, mid, large on the left side, and at the top, investment style, value, blend, and growth. And there is a billion permutations of this. But the pros have to fit into one of these boxes. And I understand why the consultants that talk to the teachers union pension of Washington State and CalPERS and what have you, but it's irrelevant for you. You don't. Fitting into one of these boxes is an absolute waste of time. The pros have to do it. And so here's my take. The pros have to own the Apples of the world. They have to stay in one of these boxes. You do not. There are plenty of other opportunities, and frankly, I want you to use the institutional handcuffs, take them off of yourself, and go to where there's other opportunities, which brings me to the plethora of ETFs that have exploded over the years. This is a list of everything that's out there. There's almost 2,000 plus equity stock ETFs. There's 3,000 overall, and they cover everything. I mean, they cover small, medium, large cap. They cover all those style boxes. They cover every country, every commodity, long and short, everything you could think of. And so there's something out there that's going to be better than Apple. And I'm finding it, and I'm imparting it to you. So I'm hoping making my point here. Next, because I'm crazy, and I've been a Market Smith and a Bill O'Neill fan for 30-plus years, I input every ETF that you just saw on that last chart into my system, and I go through them monthly at minimum for you, and try to find new things that are occurring that we can invest in. Not trade, invest in. And that's an important distinction that I want to make. Most pros don't beat the market. And I know you know that, but this is pretty stark. This is the Spiva report. And 94% of investment pros underperformed the market over the last 20 years. So only 6% are beating the market. 85% over the last year. So you get these brilliant people with all these spreadsheets and all these dividend discounted cash models, and it doesn't work. So what works? I really wanted to find that, and that's why we're sitting here today. So here's my take. I want you to do both. You can buy the S&P 500. Most of you have retirement accounts in 401ks that make you automatically buy the best companies that the S&P decides, which will have the next Apple in it, and just keep buying and buying and buying because I'm making money in a down market. I'm so bullish on America, it's a joke. We all get up to make our lives better, to invent new things, to better our lives, and make the world better. And so stocks, they go up 70% of the time, but for the 30, I want to be a help to you. And we're in the 30 right now. So I want you to go out and buy the S&P for a portion of your assets, the retirement accounts, make it easy, make it automatic, make it dispassionate for you, automatic. And then I want you to come and see what we're doing. And what we're doing is making money in a down market, and this flat out works. It does. I didn't know this this is my shameless plug. We're up 5.87% through October. We're up close to 8%, a little over that right now. S&P is down 20% plus. And I can't be more transparent about how we're doing it. When I started this, I thought it would work. I've been in hedge funds, mutual funds, institutional firms, which is why I see the hugging of the indices and the fitting into the style boxes. But now we're coming up on 2.5 years. I'm convinced this works. It just flat out works. I draw your attention to the bar charts. We're up 36%. There we go. Up 36% since inception, 2.5 years. A bull and a bear market. So this is, I think, meaningful. We're up 10% better than the S&P, with all those things that I mentioned, the Apples and the Microsofts and the Teslas of the world. And we're 5 times the hedge funds that are charging 2% fees and 20% of the profits. So those are the cold, hard facts. Facts are stubborn things. I'm proud of what we're doing, and I'm not resting on my laurels. I'm terrified that these numbers start looking worse, and that's why I pour over all the information that I do and present that to you. So just a reminder, please go to my website, stockmarketauthority.com. Please sign up for free for my newsletter. Please subscribe to my YouTube channel. I'm very visual, as you can see. So I want you to see what I'm doing. If you can't, and you want to listen to me while you're working out and walking Murph, then or your dog, then please follow the podcast. Please follow me on your favorite social media, TikTok, etc. So when I break in, you see what's going on. But you can crush the pros. I want to help, and thanks for joining along. My next segment, the mailbag, and if I haven't gotten to your questions or I don't today, please keep firing. I'm going to get to, I can't say everything, but I'm going to get to a lot, and especially if the same themes keep bubbling to the surface. So Murph came in and said, Bakes, you bash institutions. I think bash is a very harsh verb. I wouldn't use that, but so be it. But the institution's money drives ETFs and stocks higher. That is true, but you shouldn't put their handcuffs on you. That's my whole point. And to illustrate this, I highlighted my Monday post from Tesla, where I said Tesla closed below 200, 163 is the next stop. And you see these lines that I have on the chart here. The Tesla chart going horizontal on the 200, and 163 is the next level. I can't see if that's it. But I've added an up and down volumes here that you can see. October 2019. This is what a bottom and a breakout looks like to me. You have a high volume, spike in volume. Stock takes off to new highs, and we're off to the races from October 2019. This is Tesla that I'm referring to, which seems to be a lightning rod, so I keep going there because I have fun with it. October 2020, you see the follow-through. And Murph, I don't care what institution this is. I don't care if it's Cathie Wood. I don't care if it's Citadel. I don't care if it's Elon's mom. Somebody knows business is getting better at Tesla. They're putting their money where their mouth is. They're bidding the stock up. My point with all this, for this longer-term perspective, that was 2019, 2020. It's the end of 2022. We're reversing all this. The down volume is picking up. The institutions are saying, I don't care that it's 1.7% of the S&P. I'm getting out of here. And I don't care if it's because of Twitter or delivery schedules or what have you. The stock is going down. So I hope that's helpful and explains how I view the institutions. Next, Charlie from New York asked about the best platform, trading application, if you will. For me, it's Fidelity because I'm old and I'm familiar with them and I trust them and like them. And they are commission-free like everybody else is. Robinhood made everyone go free, and so now Fidelity is the case. For you see here for beginners, that might not be you, but the platforms that are viewed by Investopedia, not me. I have not done extensive work in this, full disclosure. But you don't see Robinhood on the list, and you don't see some of the newer ones on the list. So we hold most ETFs for long-term capital gains, so 12 months plus. I don't invest on the phone, so that's not that important to me. But you see the TD Ameritrades and what have you that are, leave that there for a second. These are the ones that I would explore first. Fidelity works great for me. I don't do anything fancy. And oh, by the way, I don't trade that much. I mean, I'm an investor. I might put an investment idea on once a month, twice a month. I don't want to have to leave a meeting and run frenetically to my screen. So those are my thoughts there. And I want to hear your feedback. What have you used? What do you like? What do you hate? And I'll pass that along to the audience so that everybody has the tools. And this is great. Next is short selling. Bobby from Virginia, who's my son, who I love very much, and he turns 26. Happy birthday, buddy. Next week, which means I'm 106. You're welcome. So I've got the scars to prove that I know some of this stuff in the stock market. This is how you short stocks. And you ask about the best way, I'll get to that. But the way I like to think about it and explain it, and I did this to my dad, years ago, was I view short selling as the reverse of buying low and selling high. It just reverses the chronology. You sell high first and buy low. So because of quirks in the stock market and history and what have you, this is a good illustration. You go to a broker, you borrow the shares of ABC stock in this example, 10 shares of ABC. And there's some complications about that we can go into later if you want to, about is it tough to borrow, how expensive it is to borrow, that kind of thing. But so let's say this is easy. You borrow 10 shares of ABC, not a real stock anymore. You sell the stock at $500, $50 a share. It goes down to 40, so there's 400. You buy or cover the stock at 40. You pay back the broker and you keep the $100. That's the way that works. And I'm going to use a real-world example, and I'm picking on Tesla today. I don't know why, but I feel like it. Anyway, so here's Tesla. Full disclosure, I only did this through the SARK mutual fund, Matthew Tuttle's SARK fund, which the Short Innovation Fund, which is the inverse of Kathy Wood's ARK, ARKK. And this, in my opinion, Bobby, this is the best way to short stocks. You've got ETFs that have gone through all the machinations, have the brokerage relationships, have the margins account, have the ability to borrow, and they'll do it for you. So, yes, if you really want it, you feel strongly about a particular one or two ideas, great. Go to your brokerage and do it. But I like, going after entire groups of stocks. Stocks tend to move in groups. In this case, it's the Kathy Wood stocks. And her cleanest dirty shirt, which I think I mentioned on the last show, a reference to a Johnny Cash song, is Tesla. This is now an ugly chart joining the other 30 or so ugly charts in her portfolio. It used to be semi-pretty. Now it's just ugly. So here's the arrow of shorting the Tesla at 300, covering at the 200 level, just to keep the math simple. I wanted to have, nice round numbers, but this worked out perfectly. So 300 to 200, you pay the broker back, you take $100 profit per share in about a month. Now, by the way, that happens very, very seldom. Very, very seldom, but it's an idealized example. Please also see this arrow at the top here for Tesla in January, November, that corresponds to the AX, the Short Innovation Daily Chart, SARC, where we bought this at 11/21, November 21st, at $34. And we're now at 64. We're up 90%. We're coming up on long-term capital gains. It's a big winner, and it's paid for a lot of the mistakes that I've made over the course of the year. But the reason I bring that up is that corresponds, that buy, with that peak in Tesla, the best stock that Kathy Wood had, that's now giving up the ghost. And the timing is not, and I didn't frankly make that connection at the time. This is going back and doing the postmortem, but you can see that the rest of the portfolio was starting to go down, and now Tesla is joining the party. This is the ARC fund, the inverse of what the SARC is. November of 2021, we shorted this at 113. The ARC fund started going down at 113. We're now at $34. So that's what we do all day, every day. And I hope that I explained short selling a little bit better. And if I haven't, please, I'll clarify anything you need me to. Next is the portfolio, how I'm making money in this down market. And I get asked this all the time. And I'm showing you here the portfolio. This is a real Fidelity account that my wife and I have. We have the S&P plugging along in the in the retirement account, and I spend about 3 minutes a night doing this. I look at this and I look for red, and if I see anything down 15%, I'm gone. I don't talk to anybody, consult anybody. I don't have large losses because I've seen this movie, and you've seen this movie. And be honest with yourself. Go to your portfolio. If you have a bunch of big losers, you start thinking about adopting this, especially this time of year. If you have a bunch of capital gains, take your losses so you can tax loss harvesting is the fancy term, but go through the portfolio and sell your losers. That's the very unfancy term. Reduce your check bill. Check with your accountant, of course. But then you can buy anything you want. You can buy the stock or the ETF back in 30 days. So here's where we are right now. We're 68% short the ARC stocks, which is now being added by, exacerbated by the crypto fiasco with FTX that just started to break yesterday. I might cover that more. Let me know if you have questions. The SPACs, which we talked about, emerging markets, especially China, the Qs, which is Apple, Tesla, Microsoft, etc. The Russell 2000, the small cap growth, that's a style box I don't like, so I'm going to go the other way of the way a lot of the world is going. Real estate is starting to go south. The financials, which hasn't worked that well yet, to be blunt, and the big European stocks haven't worked that great. Those are my only two losers, those last two. My wife and I, agriculture, which nobody has told you to buy, except for us, I think. Wheat, soybeans, etc. We own small cap energy, which I think is going to continue to go to work out. I might add to that. We'll talk about that if I do. And 21% in cash. This also goes to the institutional discussion that we had. There's no institution that can have 21% in cash. The consultant says, we paid you to be invested in small cap growth. That's your box. Stay in the damn box. And you can have 5% cash, but you can't have 21 because we're not going to pay you for that. So cash is now paying you 3%. The market's down 20. Cash is no longer trash, and I have no problem to have that kind of flexibility to go audible into whatever looks like the Apple chart from 2005 and the Tesla chart from 2019, and boy, nobody's looking for those more than me. I went through this past weekend, especially at month end. I go through all those charts that I talked about, thousands of them. And there's nothing new to buy yet. I'll tell you when there is. I'll break in with new investment ideas. but I don't see anything that gets me too excited at this stage of the game. So my last segment, I want to leave with something, I call it much-needed levity. And I look for levity as much as I look for stocks and ETFs that are going up. I had Day with Bakes. That's what I give my family for Christmas. Sometimes it's a threat. Sometimes it's a promise. And took him to Gotham Comedy Center and he actually took me, but I took him out to other things. Went to the Gotham Comedy Center in New York, which I highly recommend. And as a surprise, Jim Gaffigan came on and did 25 minutes. This is him, about 6 minutes long. Go to the link. I can't play it automatically because the lawyers get involved. But him running the New York City Marathon is about as funny as me running the New York City Marathon and about as likely. So I want you to listen to that and enjoy it and get a chuckle. So please go to my website, stockmarketauthority.com. Please sign up for free for my newsletter. Subscribe to my YouTube channel and podcast. Follow on your favorite social media. Email me, bakes@stockmarketauthority.com. Please go to Twitter @BakesTakes_. DM me there for questions, thoughts, ideas, complaints, criticisms. Thank you. This is Bakes. Hope I've been helpful. I will see you next week. Keep smiling.
The views and opinions expressed by the hosts, guests, or callers of this program do not necessarily reflect the opinions of the Studio 21 Podcast Café, the United Podcast Network, its partners, or affiliates.